Hi, Michael. Hi, everyone, and welcome to our webinar on understanding the AASB's new climate-related disclosure standard.
Hi.
Before we begin, I'd like to acknowledge the traditional owners of the land on which I'm joining you from today. That's the Gadigal people of the Eora Nation, and pay my respects to elders past and present. Thank you all for joining us today. As I'm sure you're aware, since a fortnight ago, legislation in Australia has been passed to mandate climate-related financial disclosures. The new climate-related disclosure standard was published yesterday alongside the voluntary sustainability-related reporting standard. And we're excited to dive into the new climate-related standard and take a look at how this might impact your business. Before we dive in, I'll just draw your attention to the disclaimer on your screen. While we're very familiar with these standards, we are not legal experts, so for specific legal advice, please consult with your legal counsel. And then who are we? A quick intro. So I'm Amy, Customer Success Lead at Emmi. I'm a chartered accountant and I've spent 10 years working in financial and sustainability reporting. Joining me today is Michael Lebin, Emmi founder and CEO, a chartered financial analyst with over 15 years experience in climate finance. We're Jenny from Emmi, specialising in financed emissions data and climate risk analysis across all major public and private asset classes. Our experience across both finance and climate uniquely positions us to guide you through these new ASRS requirements. Okay, let's get started. Michael, can you give us an overview of the Australian Sustainability Reporting Standards and why they are important?
Yeah, sure, Amy. So the Australian Sustainability Reporting Standards, or ASRS, which is just another acronym that everyone gets to become familiar with, has been developed by the AASB, which is the Australian Accounting Standards Board, but it's actually hasn't come from nowhere. They're based off the international standards, which were developed, were released mid last year by the International Financial Reporting Standards. Their Sustainability Disclosure Board basically created an idea of a standardized approach for financial climate disclosures globally. And so the AASB has basically taken them and modified them for Australian context with a few nips and tucks. Basically, there's two main standards. There's AASB 1 and AASB 2. AASB S1 is voluntary right now, and it talks about sustainability in general, whereas AASB S2 is one that focuses solely on climate and is mandatory and comes into force as of 1 January 2025, i.e. next year, and has applications across like major corporations, or actually all reporting bodies, all companies caught by the Corporations Act in a staged approach, as well as asset owners, asset managers, banks, and insurers. So the idea is to give investors and users of financial statements a clearer understanding of the real risks and opportunities that are presented because of climate change. Now, the biggest thing to emphasize here is this is not a small task. This is perhaps the biggest uplift in financial reporting requirements in the last 2, 3, 4 decades. So it does position Australia as a leader in climate accountability and reporting and understanding, but there is a lot of work that needs to happen.
Absolutely. Thanks for that overview, Michael. Now let's get into some of the specifics. What are some of the key changes in reporting practices that businesses need to be aware of now that the climate standards are in place?
Yeah, absolutely. So some people were already doing a lot of the stuff with regards to what AASB or the international IASB was requiring. But the biggest difference is this is now mandatory, so everybody has to do it, and everybody has to do it in a standardized way. So basically, at a whole level, it's about disclosing the risks and opportunities that are coming from climate change. What that means is there's detailed quantitative disclosures that need to happen. So it's about you need to be able to explain and disclose your scope 1, scope 2, and scope 3 emissions of your organization. And that also includes financed emissions if you're in financial services. But then you also need to do detailed scenario analysis that explains the risks and opportunities of climate change, which is around both the transition and physical risk. Now, the scenario analysis in the AASB in the Australian context is a little bit more prescriptive than the international, where they say there must be at least 2 scenarios, and one must be at the 1.5 degree world scenario, and the other one has to be at a greater than 2.5 degree warming scenario. That is a nuance between IASB. IASB is less prescriptive. It just says you have to do scenario analysis. So it's just one of the examples of like some of the nips and tucks that the Australian regulators and standard setters have made. What is important to also understand, though, is it is a phased-in approach. Not everybody has to report straight away. Basically, first cabs off the rank are the bigger organizations. And the process they've taken here is eventually the whole market needs to be able to understand and report this. But the standard setters have said this is a big uplift. There is a substantial cost to get this done. So the ones that are most resourced and most prepared to do it are the ones that come in first. So you can kind of see there's a group 1, group 2, and group 3. There is also a specific caveat for asset owners, because there was a bit of confusion. Where does an asset owner sit? They are basically, unless you're a really small asset owner with less than 5 billion under management, you have to start reporting for your reporting period as of 1 July 2026.
Great, that's really helpful. And to help our audience understand how to approach these new requirements, could you explain how the framework is structured?
Yeah, so as I kind of mentioned before, people have been reporting climate disclosures in some way, shape, or form for a while, and that's really come from the Task Force for Climate-Related Financial Disclosures Board, or TCFD, was what was deemed as best practice. And the TCFD had this idea of there was 4 sort of recommendations that you needed to disclose. It was around governance, strategy, risk management, and metrics and targets. Now, the IASB and for now the AASB in Australia, and the different standard setters across other jurisdictions have basically adopted that same approach with regards to the framework. Is it you need to be able to explain what the governance is around how you understand the risks and opportunities of climate. You need to understand, talk about your strategy of how you manage and basically optimize those risks and optimize those opportunities and minimize those risks. How you then basically implement the risk management around it. And then, the base of all of this in that left period, as you can see, is the metrics and targets. Like there's a lot of data and quantitative analysis that drives all of that. Now, the way when we work, so that's the general approach, but generally at Emmi, when we talk about it, we almost flip it on its head, because it's hard to talk about governance, strategy, and risk management if you don't have the data and analytics to help drive it. So we generally talk about it the other way, as saying, let's get all the data, let's actually understand where you sit, get your scope 1, 2, 3 emissions, understand what your quantitative scenario analysis looks like, understand what the materiality and the risk really look like. And then from there, once you understand all that, you can then start framing how you think about managing those risks, what your strategy is to manage all of that, and then how do you set your governance up to meet those requirements. So there is a very structured framework, and AASB standards go through what you need to meet for each of those 4 areas in quite prescriptive detail, which is actually very helpful, because in the past it's been a little bit unstructured and it's hard to standardize and compare across reports.
Okay, that's a great way to think about the structure of the pillars. I like it. If we dive a little deeper, what kind of quantitative data will companies need to disclose?
Yeah, so this again is previously the quantitative data was a suggestion, whereas in the AASB and also like the international, its counterparts, it's very prescriptive as what's needed. So here on the screen is literally a laundry list of what must be included to meet your reporting requirements. Now, there is a caveat around materiality and reasonable and cost to be able to produce all of this. So that is more if something's less material or is going to cost you too much, or you don't have the expertise to be able to do it, there is a caveat to not have to report it, but you have to prove why. You can't just say, oh, it's too costly, I'm not going to do it. You actually have to be able to prove why. And obviously with data and evolution of analytics coming out, those caveats obviously are expected to decrease over time. So if we just run through this, the first one I'm sure everyone's seen, scope 1, 2, and 3, including financed emissions, is the base of everything. There are some specific guidance for asset owners, asset managers, banks, and insurers in financial services in how you deal with financed emissions. We won't go into that great detail now, but if you do have questions, please come and ask us, because that is our specialty. But the difference here, like where AASB and all these standards really go over and above and the previous of, they don't just require footprint. The next bit is you have to be able to explain the transition risks and physical risks as well as opportunities you see from climate change. And that is all about really thinking about it from a scenario analysis perspective. And so here you can see that you need to talk about a 1.5 and at least a plus 2.5 degree scenario. You can put more in, but these are the bare minimum. There's discussion of capital deployment. Now that will change whether you're a corporate or whether you're a financial services industry. A corporate is more about, what is the CapEx that you're doing and how is that being deployed to minimize the risk. Capital deployment in a financial services industry is more around, akin to where you're investing, what are you doing, how are your financed emissions providing you either risk or opportunity. There's the internal carbon prices you need to be able to disclose when you're doing your scenario analysis, as well as then when you're doing, if you are putting targets out, you need to be able to explain why you're doing them and you need to be able to track against them. So those first 6 things are very, very linked to quantitative data in how you do it. And we've been working with clients and the market as to how they can think about that. This last one is remuneration linked to climate considerations. And that is, how is your board and senior management being incentivized to make sure that climate is something that is considered?
Thanks, Michael. Now that we've talked about the quantitative data requirements, let's talk about how this data will be verified. Can you explain a little about the assurance requirements for climate reporting?
Yeah, absolutely. So this is also new. Generally, there hasn't been that many audit provisions in climate disclosures in the past. For those familiar with NGAs, there is a bit of audit needed in the NGAs scenario, but that is a very, very limited, that is a very targeted specific area. When we're thinking about assurance across mandatory climate disclosures, there is an understanding that the data is going to be a bit gappy. Like not everybody reports right now, and there is even in the standards it talks about that scope 3 does require modelling and generally estimations of supply chains, which we just don't have precise information on just yet. There is also a preference in AASB and IASB for timeliness of data rather than lag data. And so that also basically lends itself to saying it's preferring modeled and estimated numbers today rather than waiting for 12, 18-month lag data of reported emissions, because what AASB and IASB is requiring is climate reporting now needs to become coming out at the same time as financial reporting. So the reason I provide all of that is that said in the context is there's a lot of estimations and models that are going to be used to be able to get to the numbers. So how do you go about auditing and providing assurance? So there is a bit of a staged process, and this is still being worked out. And whilst we're not auditors and we're not standard setters, we are working actively with audit teams across the major audit firms as to what this all looks like. Basically, in the first year, it's believed that it's going to be a limited assurance approach on just scope 1 and scope 2, and limited assurance in how you think about your governance and your strategy disclosures. You still have to report under scope 3, but there is no assurance required in that first year because there is such an uplift. There is that realization, like let's give it some time. Then in the second and third year, there is discussions of reasonable assurance across scope 1 and scope 2 emissions, and limited assurance on all others, including scope 3. Then from the fourth year onwards, there is expected to be reasonable assurance across all climate disclosures. Now that is where it currently is. That could be subject to change. The important thing is audit is going to play a role. And the most important thing of audit is data transparency and audit trails. So there is an expectation that there is going to be maybe some leeway given in these early years if you are trying to do the best. I make you do what you can. And even taking from, I was over in New Zealand a couple of weeks ago, the regulator over there said, if you are doing the best you absolutely can, we want to work with you to see how you do it. But if you're vagantly just not doing anything, that's when we will come for enforcement. And that's generally the tone we're seeing across jurisdictions. And then as time goes by, as we start understanding what we're doing and how this really works, things will get tighter and tighter. But it means that you do have to start. You can't just ignore this.
Great. Now, we've touched on this a little bit, but it would be great to talk a little bit more about what difficulties do you foresee for companies in complying with these new standards?
Yeah, so the biggest difficulty that we've seen so far in working with people, so as I said, like New Zealand's actually already started. New Zealand's already had their first mandatory climate disclosures put in. They had to do them as of 31 March this year, and they're all lining up. They're actually going through the audit process thoughts now, and they're actually lining up for their second year. Every single person in New Zealand that we've worked with or spoken with said they wish they started earlier. They underestimated the volume of this task. It's not just about getting the data in, it's it's the reporting, it's the governance, it's setting the frameworks up and all of that. To quote again from when I was over in New Zealand, Helen Skinner, who's the head of responsible investment in ANZ Asset Management, actually said, I have a warning for my Australian cousins, beware of the climate reporting iceberg. What she meant by that is the report itself and the final data may only look like a small little bit, but there is so much that goes underneath that they wish they started earlier. And this is coming from people that started 18 months ahead of their first reporting date. So the word is start 24 months. Do a practice view. That is what best practice. Do a practice run. Understand what it looks like. You don't know what you don't know, so you need to start. And if you do a practice run, you actually identify all the things you don't know, and you're not pushing yourself up against compliance timelines and potentially getting yourselves into a bit of a problem. And so that's what we're seeing, and that's because data gaps and quality issues do exist. There's definitely complexity around Scope 3 emissions, let alone just finance emissions, but in general, really understanding what you're thinking about scenario analysis, what does that mean? You can see there's a whole laundry list of all of that. But the biggest message has been, this is a huge uplift, and you really need, rather than seeing this as a compliance cost and something you just need to do, if you start early, you can turn this into a competitive advantage. And what we're seeing people saying, well, if I need to do it now, I also want something that I can get decision useful out of and grow into my investment management, CapEx deployment strategy going forward. So there are a lot of challenges, but there's also a lot of opportunities if you get on top of this.
So quite a few challenges, but now let's talk about the solutions. How can Emmi help companies meet these new reporting requirements?
Yeah, absolutely. So as you'd probably guess, we're a data and analytics company. We're not going to write the report for you. We're not positioned to do that. But what we can definitely do is, and then we've helped with a lot of other people, provide we work generic, like wholeheartedly in the financial institution space. We don't generally work with corporates at the moment. So this conversation is designed for asset owners, asset managers, banks and insurers and the like. We have market leading coverage. We cross every major asset class. So rather than having to go to multiple sources or do some stuff internally, we've got full databases for listed equities and listed fixed income. Plus we can also cover your private assets across private equity, private credit, private real estate and private infrastructure. And we can do that because of our machine learning powered Scope 3 calculation processes that can basically plug in all the data gaps where there are no reported emissions. Then the next piece that you need to do is this scenario analysis. And this is what Emmi has been built from. We've been built from the ground up. We didn't actually build ourselves to be a carbon accounting firm, but we built ourselves to create really robust investment management quality, scenario analysis and risk analysis. And that's what is at the core of mandatory climate disclosures, is understanding what that looks like and how it looks across scenarios. So we build that out for you, and then the outputs fit quite well into are quite compliant for ASRS and other mandatory climate disclosures. And then that helps you to quantify the impacts that climate could have. I'll also touch on the assurance-ready bit. As I said, no one quite knows what assurance is really going to look like yet. It's still being worked out. But we are engaged and plumbed in and talking with audit firms to understand what best in class looks like and start building out methodologies for the market so that this can move. We don't just sit there going, oh God, how do we do it? We're actually proactively doing this. So that's how we help you get to compliance. But one thing that is very interesting now when we're engaging with our clients and the market is, because this is such a big uplift, we're hearing a lot of people saying, well, I don't just want to do this for regulatory purposes. If I'm going to put the time and effort and manage what I measure, I want something that is actually going to be able to grow into a proper investment risk management system. I want to be able to isolate the risk factor of carbon and climate and then put it into my system in the same way that I do credit risk, inflation risk, market risk, and the like. And so we're seeing people saying, I don't want a black box. I want something I can trust, something I can embed, so I can then have actionable decisions off the back of it. So it's going beyond the compliance piece is what a lot of people are now going for, especially in financial services.
Great. As we approach the end of our discussion, it'd be good to consider some practical next steps. Michael, what advice would you give to businesses preparing for ASRS compliance?
Yeah, so the biggest one, start early. Started yesterday. Like, I know that sounds like a broken record, but this is such a big uplift. The clients we've worked with have also said, like, there is so much. It's not just the data that you need to get. It is understanding everything. So the first piece is just review what you're doing. Understand it. You know, you can do it yourself. Like, understand what you've got and understand the gaps. Then just make sure you've got stakeholders on board, get your governance system worked out, make sure that you have approval to go after this. Then come in and think about the data. And this is where we can really help. 3, 4, and 5. Really think about what your emission footprint looks like, especially across financed emissions, and think about how you're going to tackle scenario analysis and which scenarios you're going to use. There's a lot of different scenarios. And even though AASB has been prescriptive saying you must use a 1.5 and at least something with greater than 2.5 degrees warming, there is still a litany of different scenarios that can be used in between for those two descriptions. Then talk about how you're integrating climate risks and opportunities into your process and into your businesses, and then develop the transition plans off the back of that. That gets you basically the bulk of the way there. But as we said, you need to start thinking about auditors. So it is worth engaging with the audit community early to understand what this looks like, because the biggest risk that we see is not necessarily right now, but we see it in about 2 years' time when all of this really comes to the crunch. And if you haven't engaged early and got your ducks lined up and know where your resources are coming from, you could find that you have a compliance requirement to do and there's no one there to help you. Obviously, we will do the best we can, but we can foresee, we've already seen in New Zealand, an absolute tsunami of requirements of people trying to do everything last minute. And that's why it's so important to start early. And then obviously the last piece is you need to report your disclosures. I have seen, anecdotally, I have seen some people type into ChatGPT and post it on LinkedIn, what does this look like? And tongue-in-cheek saying, here it is in a one-pager. Very much tongue-in-cheek. Not sure that would pass muster it across the regulators' boards when they're looking at that, though.
I don't think so. Great, good advice. Bottom line, I think, is start early and start thinking about it.
Absolutely.
Okay, I'd like to thank you all for joining us today. To keep our webinar focused and concise during the busy workday, we aren't doing a Q&A today, but if you do have any further questions or you'd like to learn more about how Emmi can support your climate reporting journey, please email us at info@emmi.io or contact us through our website. We're here to help you navigate these new standards with confidence. Thanks again.